Hi everyone, Raphael, founder and CEO of Zendog here. Today we're going to talk about a very important topic, pricing strategy. We're going to go through an overview and case studies as well as real life experiences and examples. If you are watching this video, you are likely in charge of setting a price for the product that you've built or the service that you've built. Maybe you've already set one and you're not quite sure whether it's the right one, or you are currently working through, strategy redirection and are aware of the importance of pricing on the success of your business. Getting pricing right or wrong can really move the needle for your business. I've experienced this myself. That's why I will talk about case studies in a little bit. And ultimately, the pricing strategy you choose, for example, whether it's high or low, significantly impacts what you do as a business. For instance, if you charge high prices, you are in the B2B space, you would be an enterprise. And if you charge low prices, you are in mid and small market. And that's a completely different business, right? So pricing is important. We'll talk about that today. In terms of my background, so you know who you're listening to, I'm the founder and CEO of Zendog. As mentioned, we help businesses grow faster. That is our mission. Before starting Zendog, I was a principal at Roivant. You can think of Roivant as a principal investor, meaning we've raised capital for our own balance sheet and then deployed that into a portfolio of startups at peak about 35. We've raised about $3 billion from SoftBank, Founders Fund, and other strategic and financial investors, and went public on the NASDAQ in September 21. Before joining Roivant, I started two startups successfully as well. So I have both the investor and the operator perspective. Either way, let's get back to pricing strategy overview and case study and just dive right into it without further ado. And I will have to reduce the size of my video stream here just to fit everything onto the screen. All right, so there are obviously many different strategies that you could be using. So let's go through those so that we have a basis for discussion here, and then let me give you also some examples. The first strategy that I think is important, especially for new businesses, is penetration. So define a strategy that's based on penetration. Get into the market first, set a low price, and then raise prices over time until customers start complaining, until demand starts to decline. An example here is my own business, Zendog Labs. We started with a relatively low price, and then as we figured out what the needs in our market are, and as we figured out how good we are and how we are positioned competitively, we kept increasing prices until at some point we said, all right, let's increase prices so much that we can focus more on product development and less on service delivery, meaning we've reduced demand to some degree intentionally. The second one is cost plus, where you target a percentage on, in terms of gross or net margin. I think the ideal case is that you reach a 80% gross margin. Gross margin means revenue minus your cost of goods sold. So the additional cost you have for selling an additional unit of your product or service. In an hourly based model, for instance, if you're selling consulting services, it would be the additional money that you're paying a consultant on your team to deliver the service. In e-commerce, it could be the manufacturing cost of that good that you're selling. That is your cost of goods sold. And if you target 80%, that's going to lead to very, very attractive profit levels at the bottom line. So cost plus is a great way of pricing if you have visibility into what your costs of goods sold are, and you can actually break it out cleanly. All right, next one is is competitive, kind of obvious. You price in line with what your competitors are charging. The benefit here is that you are validating, or you're using a price that's market validated. This is particularly true for technology startups where you want to make sure that you validate what you do externally and don't use internal assumptions as much as possible. It's especially true for activities like market sizing, where I see many startups use their own assumptions around what pricing is realistic in order to inflate the market size that they're in. Well, the reality is different, and competitors are in the market, they're actually selling. And so that's a good benchmark to use. Next one is value-based. So price the service or product you're delivering based on the perceived or actual value. The actual value is, for instance, commonly used in the healthcare setting. Let's assume you're trying to price an intervention for patients that's being applied in the hospital, so the inpatient setting. Well, in that case, you could price that service or product based on the cost that you're saving the hospital and the payer through your service or product, such as a pharmaceutical product, commonly called health economics and outcomes research. There is an entire branch of services that helps biotech companies, for instance, figure this out. So value-based pricing is getting increasingly popular too, and demanded by some instances, especially in healthcare. Next one here is usage-based, where you're pricing and you're charging people money. It's almost like more like a business model where you're charging people based on how actively they use your product. An example that I'm aware of, but there are many, or an example I want to highlight here is Apollo, which is sort of an alternative to ZoomInfo, where you can get contact details for leads. And they will charge you, in addition to a subscription model, they will also charge you based on how many credits you use to unlock emails and phone numbers. So that's the usage base. The great thing here is that you can potentially offer the product for free to get started. And then the moment someone starts understanding what it is that you're doing, starts liking it, wants to engage more, they have to start paying. And I think that's a fair trade-off. Now, there are a couple of other strategies worth mentioning here too. Geographic pricing is the first one. You essentially charge one price in the US, one price in Turkey, one price in Switzerland. Very commonly done, especially by physical businesses. In Switzerland, for instance, which is where I am currently based, we have much higher prices for clothing and shoes and stuff like that than you would have in Germany, for instance, because the average income, the GDP per capita in Switzerland is much higher. This obviously will break at some level because people will start going to Germany to shop. People may start shopping online and importing stuff. Or in the case like SurveyMonkey, which is a product that I'm using, I just said that I'm based in Turkey and I paid, a tenth of the price that I would have paid if I had said that I'm in the US. But SurveyMonkey is doing it too. And in some ways it's fair. You just got to be clear on how you control it. Credit cards, for instance, local credit cards are a good check to make that work. Then price skimming is sort of start high and go lower over time. Premium pricing is a strategy that I like a lot, and I think it ties back to what I said on top here, penetration and cost plus to some degree as well. Coming in with dumping pricing, as you see next, is just doesn't leave a lot of margin for you to deliver good service and products. So if you actually want to deliver quality, it's always better to charge higher prices, be more selective in terms of who you partner with, and have that extra margin, that extra customer lifetime value to deliver exceptional service in case you need to go the extra mile for whatever reason. I'm a big fan of premium pricing, and I think that's the best way to build a business. However, there are dumping prices too. You could come in and say, hey, I'm going to undercut everyone in the market and win and make revenue via volume. Now, the problem with that is that you could potentially trigger the commonly known race to the bottom, where everyone keeps lowering their prices, especially in commodities or in commoditized sectors. This is particularly true. Let's say a sector like commodities, actually, right? Commodities trade at fair market prices, unless there is a supply crunch. And then last one, dynamic pricing, that's also very commonly used, is to adjust prices based on demand. Obviously, that's something I think you always want to do, also in penetration and cost plus. If you are seeing that you're pricing too low, you're being swamped with demand, increase prices, cut supply. This one here is commonly done in the travel industry. I think we're all at some point have been frustrated by airlines increasing their prices if you book nearer term to when you actually want to fly, for instance. Insanely annoying and insanely effective. So these are the key strategies. There are some interesting dynamics going on here, like pricing. Humans make purchase decisions, right? It's humans making purchase decisions, and humans are irrational. So, for instance, something that happens in services all the time, and you want to think about how that applies to your specific business across these pricing strategies. When you come in at a too low price point, people will associate things with your business, such as it's probably low value and it's probably not trustworthy, especially if it's surprisingly cheap. And if you increase your price, you will at some point start lowering demand, but potentially demand, depending on what the demand, not sure how to call this, the demand looks and feels like, you may start seeing an increase at a higher price point, which is where you start going into a smaller segment of the market that appreciates value and quality and sees higher prices as a signal of that. It can be a highly effective pricing strategy. All right, so these are different pricing strategies. Let's have a look at a case study here that I ran for my own business, where we were active on Upwork for quite some time as consultants. And Upwork fundamentally works with hourly rates, right? You set an hourly rate, and that's what you charge. And you see hourly rates here on the left. And what I essentially did is just look at, all right, if I pick different hourly rates within different categories, like search terms, growth over here, go-to-market over here, marketing strategy, sales, and funding, how many projects do you see at different pricing levels? And what is very interesting, obviously, as you niche down more, the number of total projects goes down. So here, total projects was 10K at 55 and higher. So that's the total number I was able to find. And I think this was already categorized or already picking a certain segment like sales and marketing. And then the next ones were that plus additional keywords to search for. What you see here is that, obviously, as you would expect, as you increase prices, the total number of projects goes down that is being posted by customers on Upwork, which is a marketplace to find consultants and freelancers, by businesses and individuals. For something like growth, you would see the same. For go-to-market, you would see the same. So there is a clear supply and demand curve here, where demand goes down as price goes up. All right, but what is really interesting, and now we're starting to talk about price sensitivity, irrational behaviors of consumers and businesses and individuals, ultimately, is looking at the drop when you go from 60 to 65 per hour. So in this case, let me zoom in a little bit here so this becomes a little clearer. The orange isn't particularly helpful. You see a 27% decline in the number of projects that are published at 65 versus 60. So there is a first mental barrier for people to pay 65 USD. So if you're deciding between two prices, if you want to have a broader set of potential customers, you could potentially price at 60. You could still try to upsell them into higher priced or fixed priced services at some point later down the funnel, once you're starting to talk to them. And then the next mental barrier or threshold that people are clearly seeing is going from 100 to 105. So as you go from 100, you see a drop to 105, you see a drop of 50% in demand or projects posted in that space. And what that means is that you are not eligible for as many projects as you were before. It means that you are likely going to get fewer inbounds, and that can be good or bad. It all depends a little bit on the structure of the market that you're in. But it's very clear that there are certain thresholds that people think about and have anchored themselves for, and if you cross those, it has very, very real implications for your business. One example here is SaaS businesses. I think most subscription-based businesses are pricing somewhere between 5 to 20 USD per month. Go 50 plus, and you will have to justify your pricing, especially if you are more in a small ticket mass markets type of environment. And the other one, in our instance, for instance, for quite a long time, we priced ourselves at $200 per hour because we wanted to reduce demand, work with a more select set of customers, and have more time for productization and strategy development. And these are decisions you can make. You obviously have to think about how to maintain existing customers. As you increase pricing, you want to grandfather them into your new pricing, or just keep them on the old. And you will have to navigate, especially if you go from a higher price to a lower price, what you do with your previous and existing customers. You will likely have to transition them over into the new pricing, and they may get disturbed or pissed off even that they had to pay more up to here, and your net promoter score may fall. All right, so that's pricing. In a nutshell, very important to decide how you price your product. It's a process rather than an end state, so keep experimenting and experience what it means for your business if you change your pricing. I'm very serious. It will have big implications. All right. If you liked this video, make sure to like the video. If you have questions, definitely drop a comment into the comment section below. I'll get back to you personally ASAP. And if you want to see more of our content, we're constantly working on exciting new content. Make sure to hit that subscribe button. It would mean the world to me, because it's a positive signal that you're enjoying the stuff we do, and who is not looking for that. All right. Hope you enjoyed this, and talk to you soon. Bye-bye.